Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Hello, in today's video we'll be taking a look at the Wednesday, October 22nd, 2025 trading session for the SPX CBOE index, and we'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator for trading SPX 0DTE options. Specifically, we'll be using the newest version of this indicator, the V2.0 version, which was released a few weeks ago. Alright, so some of you may already be familiar with how this indicator works, but for those that are new to this channel and just seeing this type of video for the first time, I will run through how this indicator works. So at 9:30 a.m. Eastern New York time, the SPX index opens up, and on the first tick at 9:30 a.m. Eastern New York time, you will get the daily key levels on your chart when you have it on the SPX CBOE index chart symbol on TradingView. So on TradingView, this would be the SPX symbol under the CBOE exchange, and that is the official SPX index. This indicator also works on a second symbol on TradingView, which is the SPX 500 symbol under the 8-cap exchange, and that is a Forex CFD symbol. There are a couple of reasons why you would want to have a chart open for this second symbol, which I will go through in a minute. We will switch now to the SPX 500 chart. Okay, as you can see here, this is the SPX 500 and the 8-cap. So on TradingView, you go to SPX 500 for the trading symbol and look for that symbol under the 8-cap exchange. So this is a Forex CFD. The reason that some people use this indicator to trade on this symbol is if they are trading through a Forex broker and they're not trading SPX index options and instead are trading through a Forex broker on a Forex CFD of SPX. So another reason is if you are doing a trading challenge to a trading challenge company like FTMO or Apex or one of the many dozens of trading challenge companies out there that offer you the ability to take a trading challenge, and if you pass it you can qualify for a funded account with them. Then if you're trading SPX utilizing one of those trading challenges, then your only option there is to use a Forex CFD because they do not allow the trading of SPX options on those types of trading challenges. So if you're either using a Forex broker to trade SPX, or if you're doing one of those trading challenges, then you would utilize this indicator on the SPX 500 8-cap symbol. Now another reason that if you're wanting to have the indicator on this symbol would be if you are trading SPX index options, one reason that you'd want to have a second chart open on this symbol would be because you get the levels for the CBOE SPX index 30 minutes before it opens at 9:30. At 9 a.m. while on this symbol, you will see a second table here, which I'm highlighting here at the top, which is the CBOE SPX levels for today's session. This table down here is the same levels over here. These are specifically for this Forex CFD, but this particular table here also comes up at 9 a.m., which I've marked off here. So at 9 a.m. you would get these two tables on your chart, and this would allow you to see the levels for CBOE SPX 30 minutes before it opens at 9:30. The reason for this is because in TradingView PineScript, even if your indicator already knows the levels that it's going to plot before the market opens, such in the case with CBOE. This indicator knows the levels at 9 a.m., but it cannot plot them on the CBOE SPX chart until the first tick at 9:30, because the way that TradingView Pine Script works is that even if your indicator knows what the levels are, if the particular symbol you have your chart on is closed, which SPX CBOE is not open until 9:30, it cannot plot them on the chart. So this method of having a second chart open, if you want to see the levels 30 minutes early, you can see them 30 minutes early at 9 a.m. through having it on this particular chart. Okay, so now we're back on the CBOE SPX chart. Alright, so this would be the chart that you would use if you're trading SPX index options. The majority of people that use this indicator use it for trading SPX index options. We do have some traders that do use it for trading the Forex CFD because they're involved in trading challenges. But the majority, the vast majority, use it for trading SPX index options, which is the strategy that we will be showing you today. Alright, so the most important level that you'll get on your screen at 9:30 a.m. Eastern New York time is this key level here, the SPX Bull Bear KPL, which stands for Key Price Level. This level is the all-important Bull Bear pivot for today's session. So each trading day before the market opens, this indicator analyzes overnight and pre-market action in the S&P 500 E-mini futures, as well as recent days price action in the SPX index, as well as current market dynamics and current volatility, and it will generate and plot the levels for you at 9:30 a.m. Eastern New York time each trading day that the SPX market is open. So every day you will get a new bull bear key price level for that particular session, along with your other levels that you see here. Now the other levels, the other main levels, which this bull bear KPL is considered a main level, the other main levels for this indicator are going to be the R1 through R6 levels above the bull bear KPL, and the S1 through S6 main levels below the bull bear KPL. So what these levels are primarily used for early on in the session is they're used for take profit levels and target exits for either bullish or bearish trades that you get an entry signal of a bullish or bearish entry signal from the bull bear key price level. So for example, the R levels above, the main levels above the bull bear key price level, are your take profit levels for bullish trades that are derived and triggered from the bull bear key price level, and the main levels below are going to be take profit levels for bearish entry signals that are triggered and derived from the bull bear KPL. The other levels that you see here up on this table here, the first one is the SPX PMH, which is the SPX pre-market high, SPX PML, which is the SPX pre-market low, the SPX YDH, which is the previous day's or yesterday's RTH session high, the YDL, which is the previous day or yesterday's RTH session low, and YDC, which is yesterday's daily close, which is the previous day's RTH session close. These key levels are also important because they can represent significant support and resistance levels that can be tested throughout the session. They also can become especially important if they are seen in confluence with the other main key levels that are displayed by the indicator. They also can represent additional exit considerations depending on how far they are from your entry point on your bullish or bearish trade. With this indicator, you can take bullish or bearish trades off of the main bull bear key price level. Those primarily happen early on in the session in most 90 to 95% of sessions during either the opening candle or in the first 10 to 20 minutes of the session. The bull bear key price level can also come into play later on in the session as well, but it's most prevalent at the beginning part of the session. The other main R and S levels, you can also take bullish or bearish trades off of those levels as well as the session progresses. We do have a video that focuses specifically on how to take trades off of the other main R1 through R6 and main S1 through S6 levels. If you look in the description of this video, you'll find links to various other videos on different topics discussing other aspects of this indicator, and one of those links will be to a video that discusses how to take bullish and bearish trades off of the other main R and S levels throughout the rest of the session. And it also discusses the two different types of trade entries, one being the standard trade entry and how to recognize that for bullish and bearish trade entries, and also the more conservative trade entry type, which takes additional confirmations and how to recognize that on your chart and how to use that in bullish and bearish trades as well. So if you'd like to see more about that particular topic, we're not going to go into that in this particular video. You can look at that link in the description of this video, and that video is approximately 25 minutes long if you would like to see more regarding that topic. Okay, so you'll also see here midpoint levels. For example, here we have mid BBKPLR1. The midpoint, this is the midpoint level between this R1 main level and this bull bear key price level. Mid BBKPL S1 is the midpoint level between the bull bear KPL and the S1 level. The mid R1 R2 midpoint level is the midpoint level between the R2 main level and the R1 main level. And the mid S1 S2 midpoint level is the midpoint level between the S1 main level and S2 main level. And as you can see here, there are other midpoint levels as well. The midpoint levels are used for several different purposes. One is they are used for standard stop losses, which we will get around to here in a few moments to show you how that worked on the trades today. They are used for standard stop losses on bullish or bearish trades depending on the level that you are taking the trade from. So as an example, if you were taking a bearish trade, as was the case today, off of the bull bear key price level, your standard stop loss is going to be the first midpoint level above the level you're taking the trade on, which in this case would be the bull bear KPL. The first midpoint level above is your standard stop loss. Conversely, on a bullish trade, the standard stop loss on a bullish trade from the bull bear key price level is going to be your first midpoint level below it, which is this mid BBKPL S1. Now, if you were taking a bearish trade off of R1, then you would simply use the midpoint above R1 as the standard stop loss for your bearish trade you're taking off of R1. And if you were taking a bullish trade off of R1, then the first midpoint below it would be your standard stop loss for a bullish trade off of R1. Same thing on the levels below. So for example, if you were taking a bearish trade off of S1, then your standard stop loss is the first midpoint above that level, which would be the mid BBKPL S1. And instead, if you were taking a bullish trade off of S1, then your standard stop loss is the first midpoint below mid S1 S2. And so on and so forth with the other different levels as well, as far as bullish and bearish trades, as far as standard stop losses. These QL levels that you see here are available to be enabled in the user control panel above and below each main level. Remember that the main levels are the bull bear key price level, as well as R1 through R6 and S1 through S6. So you can activate the QL above and below any of any of the individual main levels that you wish to take a trade from, if you would like to see those QL above and below for using as tight stop losses. So as an example, when you take a bearish trade off of the bull bear key price level, your tight stop loss on that bearish trade would be the QL above, while your standard stop loss would be the first midpoint above. On a bullish trade taken from the bull bear key price level, your tight stop loss, if you choose to use that, would be the QL below, and your standard stop loss would be the first midpoint below. As stated, the QL levels can be turned on and activated in the user control panel for any of the main levels. Also, the midpoints can be activated for any of the main levels as well. Now on default, the default look on startup of this indicator is that the following levels are shown: the bull bear key price level, S1 through S6, R1 through R6, the first midpoint above the bull bear KPL, the first midpoint below the bull bear KPL, and also the QL above and QL below the bull bear KPL. All of the other midpoints you see here were turned on manually by us for this session. We also have a video that is about an hour long that goes into all the features of this indicator, as well as going over all the different inputs that are in the user control panel for this indicator. The link to that video is also in the description of this video if you would like to see that. We're not going to go into all of the different features that this indicator offers in this particular video, or the different inputs in the user control panel. If you would like to see that video so you can see the full extent of all the features, as well as all the inputs and customization that you can do with this indicator, then I invite you to take a look at that video, which the link is in the description of this video. Okay, so an additional note here, these two tables that you see, they are optional. They are turned on by default. However, you can turn them off in the user control panel if you do not wish to see them on your chart because you wish to save chart screen real estate. As you do have the line labels for each of the levels, as well as the pre-market and yesterday's RTH levels. All of the line labels and all of the pre-market levels and yesterday's RTH levels have individual controls for both the size of the line label as well as the offset. Offset meaning you can move them more to the left or more to the right depending on your preference, and you can do the same with each of these as well. So you can make each of these different sizes. So as an example, we have the main levels turned on a large size. We have the midpoint levels line labels turned on the regular normal size, and we have the QL line labels turned on a small size. These pre-market levels and yesterday's RTH session levels are turned on to the normal size. All of these are individually controlled by groups, so you can make the QL levels a specific size for all of them and a specific offset for all of them, and you can do the same with midpoint levels. They are all controlled by a group control, so with one change in the user control panel you can make these larger or smaller, and you can change the offset for all of the midpoint levels. Same thing with the pre-market levels and yesterday's RTH session levels, and the same with all of the main levels. Okay, so at this point we're going to get into this to the meat of today's session and start going over the trades. So first off, we have the 9:30 a.m. candle marked off here with this line. This is pointing to this candle here. This is the 9:30 a.m. candle, And as you can see, we're on a 2-minute chart. This indicator works on time frames from 1 minute up to 30 minutes. If you put it on a time frame greater than 30 minutes, then there will be a disclaimer message that will come on the chart that will tell you to put your chart back to a time frame between 1 minute and 30 minutes. The best time frames for intraday trading for this particular strategy that we're going to be showing you today are from the 1 minute up to 5 minute. However, we have found that the 2-minute chart works best for this particular strategy that we're outlining today. And if you look at all of our past videos on SPX utilizing the daily key levels indicator, you will see that when we show the strategy that we always use the 2-minute chart. So that would be the recommended time frame for this particular strategy. This particular strategy uses buying puts on bearish entry signals and buying calls on bullish entry signals. This particular strategy does not involve spreads. It does not involve combinations. There's no iron condors or butterflies or any other type. That is simply buying puts on bearish entry signals and buying calls on bullish entry signals. Now we do have some people that do use this indicator for iron condors, for butterflies, and other types of spreads and other combination option plays. For those types of plays, you may find that the longer time frames of, say, 10-minute, 15-minute, or 30-minute work better for those particular purposes, but every trader is different. And if you're going to use it for a different strategy other than the one that we're showing you today, by using other different types of option strategies, then it is best for you to test the indicator on a demo account for a specific amount of time before utilizing it on a real money account so that you can refine your process of utilizing this indicator. In general, it's also a good idea when using this indicator, when you start off using it, that you should practice with it ideally for 25 to 30 trading sessions. What that does is that allows you, when using it in a demo account, such as the ones that are available now, that a lot of them have real-time quotes and realistic real-time fills. And what that period of time allows you to do is to get used to using the indicator, get used to the process of recognizing the entry signals, placing your stop losses, managing your trades, and managing your adjustments on any stop losses at any targets or closing out your trades. So it takes a while to, and this would be true no matter if you're using this indicator or you're using any new indicator, whether you purchased it from our company or you purchased a different indicator from a different company, or you found even an indicator for free that you wanted to utilize. You should always practice with it for a significant amount of time to get your process down of utilizing that indicator so it becomes secondhand to you, however long that process takes. Usually something like that would take 25 to 30 sessions. For most people, however, more advanced traders, it may take significantly less than 25 to 30 sessions and may only take a few sessions, but every trader is different. But 25 to 30 sessions will give you a significant amount of time to go through a myriad of different market types and market sessions where you will get used to utilizing the indicator, testing out the strategy. You'll have winning trades, you'll have losing trades, and you'll have all different types of scenarios that you can become accustomed to the whole process of recognizing the trade entries and refining your process of what type of trader do you want to be on this particular, utilizing this particular indicator, and specifically what strategy that you want to employ, whether you want to utilize the strategy that we outline in our videos or you would like to use a different strategy. As we noted before, that some of the traders that use this indicator use it for a different strategy, such as iron condors or butterflies or other strategies besides the straight buying of calls on bullish signals and puts on bearish signals as we do in this particular strategy. Also, it gives you time to decide what type of trades that you're going to do, whether you're going to utilize this indicator for just scalps or if you're going to utilize it for regular trades, because as you'll see here when we get through the going through the trades here, there are different rules for scalping versus regular trades. Okay, so getting into this first candle here, there's the 9:30 candle. We're on a 2-minute chart, so this candle opens at 9:30 market open and closes at 9:32. You can see on this candle here, it did open above the bull bear key price level. However, it crossed below the bull bear key price level and also closed below it. So it opened above, crossed below intra candle, and closed below the bull bear key price level. So if you were going to take the trade on this 9:30 opening candle, this is your bearish entry signal. Cross below and close below. There are there are also other types of bearish signals that you could have on the opening candle. For example, if this candle had instead opened below the bull bear key price level, stayed contained below the bull bear key price level, and also closed below the bull bear key price level, that is also a bearish entry signal. The main point is that it is closing below the bull bear key price level. So you want to hold off, especially on the opening candle, until if you're going to be trading the opening candle, you want to make sure where this candle is going to close. Because even if it opens below, it could close above, and then you would have a bullish entry signal instead of a bearish. So this candle could have crossed below, and then it could have also risen back up and then closed above. So the important thing is where it does close. Now, there are some instances on opening 9:30 a.m. candles where you would want to not take the opening trade. And those instances would be where the opening trade, or the opening candle opens above, stays above, and closes way above the R1 level, or opens below, stays contained below, and then closes way below the S1 level. And the reason for that is it is too far away from this bull bear key price level. So you do not want to consider that a trade to be triggered from it, even though it's the opening candle. Those types of sessions will happen every now and then, and if you see that happen, it's typically best to skip that trade and to not take that opening candle trade in an instance of that where it is opening and closing far outside the R1 or S1 level. Instead, when something like that happens, you want to instead be patient and wait to see what type of gap and go situation that you're actually in by letting the session play out more. And then in that case, you may end up just taking a trade off of the R1 level or the R2 level in the case of it being up here, depending on how price action is dictating the course of the session. Or in the case of a bearish trade, you may end up taking a trade off of the S1 or S2 level, or another level depending on how the session is playing out. But in the vast majority of cases, the opening candle trade, if you choose to take it, is going to occur within the range that we're talking about here. And very few times during the year will you see something like that happen, where it does open and stay contained and also close way out above R1 or way below S1. Also keep in mind with this indicator that utilizing this strategy, there is not a rule or obligation to take the opening candle trade. Now you'll see in most of our videos that is what we do, and that is basically an option. there are many people that use this indicator that prefer waiting for the session to play out and then choose which main level they prefer to take trades on. And that's all part of what I was talking about earlier in refining your process by using this on a demo account for a significant amount of sessions to find the process and method that you like best with sessions using this indicator. So just keep that in mind, that if you already if you have an interest in possibly purchasing this indicator, that we will recommend that you do use it for a significant amount of time on a demo account before using it on a real money account, so that you can become accustomed to using the indicator and you can find the best process for the strategy for the way that you would prefer to trade with it. Okay, so here on this is a bearish entry signal because of the cross below and close below. If instead this had crossed above and closed above, then instead it would be a bullish entry signal if we were inclined to take this trade. Since it is a bearish entry signal, then the next thing that you need to decide is which option strike you're going to use. The way you determine that with this indicator is on any level that you take a trade from, any main level, meaning the bull bear key price level or any of the main R levels or main S levels, there are always three different options that you have. One is an at the money option, and then there are two out of the money options. We do have a link to another video in the description of this video, which again is about a 20-minute long video, which does go into detail about determining the at the money and out of the money strikes on the different levels. We're going to go into that today for this particular trade on the level that we're trading, but if you would like to see that video on how to do it on the other levels, then please refer to that link in the description of the video. Okay, so on this particular trade, remember that this trade is triggered from an entry off of the bull bear key price level. It's 67.39.64 for today. So the closest at the money strike for that in SPX is going to be the 67.40 strike. For those that are not familiar with how SPX strikes work, they trade in 5-point increments. So for example, 67.25, 67.30, 67.35, 67.40, 67.45, etc. So the closest strike to the bull bear KPL, the level that we're trading, is the 67.40. And since it's a bearish entry signal, that would be a put. So we look to the 67.40 put, and we look to today's 0 DTE, which means 0 days to expiration for those that are not familiar with that term, which means that that option expires at the market close today. Now, you can also use 1 DTE options, so what that means is 1 day to expiration while using this indicator, if that's your preference over 0 DTE. 1 DTE options will cost you more because there is a time value, because with 1 DTE, as an example, today's Wednesday, the 0 DTEs expire at market close today, Wednesday, and if you were using a 1 DTE in today's session, those would be for expiring tomorrow, Thursday. So there is going to be extra time value added to it, which is going to drive up the cost. Keep in mind that this indicator, you're not going to be trading and holding positions overnight, because this indicator is made for day trading. So that means that you are going to be opening and closing your positions in the same session. Sometimes you may be closing a trade just minutes later after making it. Sometimes it may be an hour. Sometimes it may be a few hours. But the main thing is that you are going to be opening and closing the trades, and you're going to be flat, meaning no open positions, at least as far as SPX is concerned, while using this indicator at the end of the session. So the point I'm trying to make here is that there's no sense in trading options that expire next week if you're going to open them and close them during the same session, meaning today's session. So if you want to go to your broker and you want to look up the data boxes for the particular trades we did today, you can follow along on the different option strikes and the different timestamps here. And if you want to figure out what the difference would have been if you had used 1 DTE on all of these options instead of the 0 DTE, then as far as maybe something that you want to see which one may be better for your purposes, then I would invite you to do that. But in today's video, we're just going to go over what we normally do, which is trading 0 DTE. So the buy price of the 67.40 put, the at-the-money put, on this 9:30 a.m. candle close, which closes at 9:32 a.m., was $18.10. For those that are not familiar with how options work, I'm sure that most of you are, but in case there are a few of you who do not understand how they work, if the buy price is $18.10, if that's the price that you're paying for the option, your actual cost is you multiply that figure times 100. So $18.10 times 100 is going to be $1,810. So that is your cost of one 67.40 SPX 0 DTE put. If the price was instead $17, then your price for one would be $1,700. If you bought two of them, you simply do 2 times 1,700, so 2 of them would cost you $3,400, 3 of them would cost you $5,100, 4 of them, if they were $17 each, would cost you $6,800. So in this case, it's $1,810, so one costs $1,810, plus if you pay your broker commission, whatever commission. Okay, so now that we've done that, and before we get into the out of the money ones that you can consider, we'll go over the stop losses. So we went over this earlier, but just to reiterate it now, this is a bearish play, bearish entry signal. This is the level that we're trading. So a standard stop loss in a bearish play is we look to the first mid-level above the level that we're trading, and in this case it's mid BBKPL R1, and that's 67.4916. So that is your standard stop loss. Your tight stop loss is the first QL level above the level you're trading. So in this case, QL above BBKPL 67.4440. Now with this particular strategy, it's usually best to use the standard stop loss. Every trader is different, and some people in their risk profile and their risk management prefer to use tight stop losses, which is why we have the QL levels for those people that prefer tight stop losses. You just have to realize that on tight stop losses, they are going to be more prone to getting stopped out than your standard stop loss. If you've seen our other videos, there are days where both of them are going to get stopped out. But in most cases, where the QL tight stop loss is getting stopped out, in most cases the standard stop loss is not. So while the tight stop loss offers you less to have at risk because it's a tighter stop loss, it is going to result in more stop outs. So just as long as you are aware of that. However, for some people that works out better for them the way they trade. Some people would prefer to get stopped out and just re-enter with another tight stop loss rather than use a standard stop loss once. So like I said, everyone's different. Everyone has a different process. That's all part, again, of using this on a demo account for a significant amount of sessions. So that's one of the things that you can decide whether you prefer using the tight stop loss or the standard stop loss on your trades. As you can see in today's session, neither the tight stop loss nor the standard stop loss were breached on today's session. Okay, so now on to what are the out of the money options that you can consider. So like I said earlier, on trades on any particular level, there's always going to be, when utilizing this strategy that we're showing you, you're always going to have 3 different options that you can take depending on which level you're trading from. But the process of determining it is the same regardless of which level. Okay, so in this case, again, the bull bear KPL. This is a bearish play, so we're looking down for our out of the money options that we can consider. Why would you consider an out of the money option versus an at the money? One is the price, which you'll see here in a second. There can be a significant difference in the price. That means that if the out of the monies are much less for you to purchase than the at the money, then you're going to have less overall money at risk. You're going to use the same stop losses regardless of whether you use an at the money option or an out of the money option. Your stop losses are still going to be the same. The difference is going to be your entry cost as far as getting into the trade. Now there is one caveat with using out of the money options, and that is in the beginning parts of the trade, when the trade starts moving in your favor, the at the money options are going to accumulate more profits faster on the same move in your favor than the out of the monies will. And after a certain amount of points in your favor, then eventually they will all move sort of in lockstep after a certain point is exceeded. But in the beginning profit stages or early stages of a trade, when it just starts going in your favor, the out of the money ones are going to move less in your favor, so it's going to take more of a move to get the same amount of profit than you would with the at the money. So how you determine the 2 different out of the money strikes is you look at the level that you're trading from, the type of trade, in this case bearish, and you look to the first midpoint level below, and that's going to be your first out of the money strike that you can consider. So what you do is you look at what is the closest strike to this midpoint below, which is 67.30.12. So that's obviously going to be the 67.30 strike, which would be the 67.30 put in this case. The price on the close of this candle for the 67.30 put was $13.20. So as you can see, that's almost $500 cheaper per option than the 67.40 at the money. So what is the furthest out of the money one you can consider? The furthest out of the money one that you can consider is going to be which one is 1 full level away in the direction that you're trading. So the shortest out of the money is the half level away in the direction you're trading, and the furthest out of the money that you can consider is 1 full level away. So in this case, 1 full level away is S1 in the direction that we're trading, bearish, which is going to be below, and that's 67.20.60, so that would be the 67.20 call. The 67.20 put. So the 67.20 put price on the close of this candle is $9.80. So as you can see here, that's almost, not quite half, but it's nearly half the price of the at the money. You still use the same stop losses as we said, and regardless of which one you choose, you're still going to have the same stop losses. So in the initial part of your trade, your stop losses are based on levels, as done here. When we get into down here, when you start hitting target exits and you have the option of adjusting your stop loss, then at that time you're going to adjust your stop loss by price. Now, a few brokers offer being able to do stop losses by the price of the underlying. One is Interactive Brokers offers that, although their platform is very cumbersome to use in my opinion. Some people love it. It's very hard to get used to. It's a lot more complicated than a lot and not as modernized as some, but some people swear by it, some people love it. I don't particularly care for it, but they do have a very feature-rich platform, and that platform does offer the availability of setting stop losses on options by the price of the underlying. Another broker which offers that is Thinkorswim. Thinkorswim used to be owned by TD Ameritrade, now it's owned by Charles Schwab. They also offer the ability to set stop losses on options based on the price of the underlying. Other brokers may offer that as well. I don't know of any other brokers that do, however, not investigated it, so some of you may know if your broker does or not. If your broker does not, you can either switch to Thinkorswim or Interactive Brokers, or if you don't want to do that, then what you're going to need to do is you're just going to have to manually do your stop loss and watch the chart, and if price retraces back up to your stop loss, you're going to have to manually close out your trade. So if you want to look in the description of this video, we also have a section that will have a link to a video made by someone else that did a nice job in pointing out how to do stop losses on options based on the underlying on Thinkorswim. If you also Google it for Interactive Brokers, you can also find ones on that. There's also some conversations about on Reddit, or you can just simply ask Interactive Brokers to support staff to show you how to do that. But if your broker doesn't offer that, if you don't want to change brokers, then you're just going to have to do it manually. You just got to watch the chart. You could of course set an alert for if it hits that you'll be notified that it hits it, and then if you're not using a broker that allows you to do stop losses based on the price of the underlying, you're just going to have to manually stop yourself out when it does touch or hit your stop loss level. But later on, as you're adjusting your stop losses, as you'll see down here, those are all done by price. When we're adjusting our stop loss to break even or break even plus a profit buffer, those are all going to be something that you should be able to do with any broker, because those are just based on price, the price of the option. Okay, so we have our three options here. Now we're going to see how it plays out. And this comes into play as for you to decide whether you're on any particular trade, whether you're just going to be a scalp, whether this trade is going to be a scalp, or whether you are a scalper in general and that's what you prefer, just scalping trades. Or do you want to do regular trades, which involve getting more of a price movement in your favor, which does involve more risk because price, of course, could retrace before it does get to the minimum required target for a regular trade. So that's also part of the process of you using this indicator on a demo account, like we said, for a significant amount of sessions, is you can also decide for yourself over using it over that significant period of time whether you prefer to use this indicator for scalping only, or do you prefer to use it for regular trades or only, or do you just prefer to make up your mind on each trade that you make. But before you make a trade, you need to already have in mind if this is going to be a scalp trade or a regular trade, because there's going to be a significant difference in how the trade is managed and also what the target level is going to be for exit. So you want to know that in advance, either because that's just what your standard trading methodology is, that you're a scalper only or regular trades only, or if you're open to doing either one of them, depending on what you're seeing on the chart, you just want to make up your mind before you place the trade which one of those two it's going to be. Okay, so first off, at 10:26 a.m., this 10:26 a.m. candle hits S1, and that is your scalping exit. So utilizing this indicator for this particular strategy, your exit for scalps is a one level move in your favor. So what do we mean by a one level move? What that means is a one level move from the level that you took the trade from in the direction of your trade. So this is the level we took the trade from. This is a bearish trade, so we look one full level, one main level below. One main level below is S1. Remember, this is the midpoint level. This is one full level. S2 would be two full levels. The mid S1, S2 is 1.5 levels. The mid S2, S3 from this level here, the level we're taking the trade from, would be 2.5 levels. S3 would be 3 levels because it's 3 levels removed from the bull bear key price level in the direction of this particular trade, bearish. If this instead was a bullish trade, and it was a bullish scalp, and the trade was taken for a bullish trade from the bull bear KPL, then R1 would be our scalping exit because it would be one full level above. If we were taking a scalping trade, a bullish trade from R1, then our scalp exit on a bullish trade from R1 would be the R2 level. If we were taking a bearish trade from S2, a scalp would be one full level below the bearish trade from the trade we're taking the level from, S2 to S3. A bearish trade from S1 would be one full level below S1, so the scalp would be S2. So in this case, the level we're taking the trade from is the bull bear KPL, so it's a bearish trade, so one full level below is S1. That's where it hits here at 10:26 a.m. and that is the one level move target required for a scalp. Now on scalps, the way we do the particular strategy for scalps is there is no stop loss adjustment on scalps once it hits the target. When it hits the one level target, you're just out. It doesn't matter if you're trading one contract, 5 contracts, 3 contracts, 10 contracts, 20 contracts. If you're just scalping, then you're out. The 67.40 put price on the candle close on this one level move is $23.70. That's a $560 profit per option on this scalp. A 67.30 put price on the candle close is $17.40. That's $420 profit per option on this scalp. The 67.20 put price on the candle close is $12.50, and that is a $270 profit per option on this scalp. Now, if you're doing regular trades, you may have seen our other videos where we've gone over this, but on regular trades, you're looking for a minimum of a 1.5 level move in your favor for the first decision point to either exit 100% of your contracts or do a stop loss adjustment or scale out of 70 to 90% of your multiple contracts and do a stop loss adjustment on the remaining runners. So a 1.5 level move is just the same process. Where are we trading from? What direction? What's a 1.5 level from that move from that level we're trading? In this case, mid S1, S2, because we're trading from this level in this direction. So on the 10:30 a.m. candle, it hits mid S1, S2, regular trade, 1.50 minimum level move target hit for a regular trade, 100% closeout all contracts, or adjust the stop loss to break even or break even plus 10 to 15%. Or if trading multiple contracts, you also then have the option of scaling out by closing out 70 to 90% of your contracts completely, and then adjusting the stop loss to break even or break even plus the 10 to 15% profit buffer on your remaining runners. Okay, so hopefully that's clear. 1.5 level move. Here you can see that the 67.40 put price on the candle close when it hits here is $31. So that's a $1,290 profit per option. The 67.30 put on the candle close is $23.60. That's a $1,040 profit per option. The 67.20 put price on the candle close is $17.70. So that is $790 profit per option. Okay, so here you can see it came down from there. It did not quite make it to S2, and then we had to retrace back up to test the S1 as well as yesterday's RTH session low. However, it broke back shortly thereafter under yesterday's RTH session low, and then subsequently broke under S1. So that is your indication there that more than likely we're going back to test at least this midpoint or the next level below the S2 level, and in this case that's exactly what happened. And at 11:22 a.m. That candle hits the S2, and as you can see it wicked through it and then closed slightly below it. Now a 2-level minimum move is the ideal target for a regular trade, whereas the 1.50 minimum move, that is your minimum target for a regular trade. Remember, if you're only going to do a 1 level, then you're just scalping and you close out. A 1.5 level move is a regular trade, and that gives you the option of either closing them all out or doing a stop loss adjustment to break even or break even plus the buffer, or scaling out 70 to 90% and then doing a stop loss adjustment on the remaining contracts. Ideally, you'd like to see a 2-level move. That is the ideal target for a regular trade as far as being the ideal minimum target, whereas this is the absolute minimum target. The 67.40 put price on this candle close is $39.10. That's a $2,100 profit per option. Remember, the cost was $18.10. Now it's $39.10, so that's $2,100 profit per option. The 67.30 put paid $13.20. It's now $31.78. That's $1,858 profit per option. The 67.20 we paid $9.80. It's now $23.40. That's $1,360 profit per option. As you can see here, we did wick down and close a little lower, and then we went back up and tried to test the S1 level, and then we broke back below here, touched, and then broke completely through again, test, and then we have this huge monster candle here. Remember, this is just a 2-minute candle, and this is about a 67.02 down to about 66.67, so that's about a 35-point move in just one candle. So that is a monster candle here. It goes right through mid S2, S3. Now that's a 2.5 level move. Why? Because it's 2.5 levels in the direction we're trading from the level that we're trading from. 1 level, 2 levels, 2.5 levels. The 67.40 put price on this candle close here, as you can see, it did slice right through this, almost went down to S3 with this wick, then backed off a little, but still closed well below S2, S3. So on the candle close, the 67.40 is 63.22. That's a $4,512 profit per option. The 6730 put is 5150. That's $3,830 profit per option. The 6720, which was the furthest out of the money that we paid $980 for, is now $48.90. That's almost $4,000 a contract. It's $3,910 profit per contract. Now in the very next candle, you can see we went all the way down to S3, touched it, and then did this monster bounce almost all the way back to the midpoint level. So on this particular comment here, we're going to show both the touch, what the option was at the touch of this level, as well as the close of this level. So for those that might be getting out on the touch, what that would be. However, for purposes of this video, we're just going to go off of the close of this level, even though we had this monster close. You'll see there's a huge difference between the two. And but for purposes of this profit, even though we're showing both of them, we're just going to go by the close. But I did want to just show you what the difference is. So at 1232, we have this touch on the low of this candle. It's now a 3-level move because it's 3 levels down in the direction from the level we're trading. The 6740 put price when SPX touches S3 was 76.90, and that was 5,880 profit per option. However, as you can see, when it closed, it only closed at 65.95, so it's $4,785 per profit per option on the close of this candle. The 6730 put price when SPX touched S3 was 66.40, so that's $5,320 profit per option. However, it did back off in this monster bounce all the way to 49.70, but that's still $3,650 profit per option. The 6720, furthest out of the money put, as you can see here, when it touched S3, it was 58.58, 4,878 profit per option on this touch. It backed off, as you can see, all the way to 41.93 on this candle close, so that was 3,213 profit per option. As you can see here, we went on this touch of S3, and just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles later, so 20 minutes later roughly, all the way back up to S2. Then tested S2, couple of candles, broke below. Now again, consecutive candles below. Now most likely headed at least to the midpoint level, breaks below the midpoint level. Now is it going to test the S3 level? Yes, it did. Tested it, hit it, closed below it right here at 1:40 p.m. So at 1:40 p.m. hits S3 again. This time it closes below it. So this is your 3.00 level trade again, 3 levels down from this. The difference being this time it closes on or through it here, as opposed to this one, which actually did touch it. However, it backed off quite a bit. Here on this candle close, the 67.40 put price is 75.80, so that's a $5,770 profit per option. The 67.30 put price on the candle close is 69.25, so that's $5,605 profit per option. The 67.20 put price on the candle close here was $58. That's $4,820 profit per option. Okay, so now we're going to take a look at the thinkorswim data boxes for these different these 3 different options, the at the money and the 2 out of the monies, before we conclude the video. First, we're going to take a look at the 67.40 put option. So here we have the 9:30 a.m. candle close. This is a 2-minute chart as well for these options. So 9:30 a.m. candle, close $18.10. Next we have the 1026 S1 scalp, $23.70. 10:30 a.m. hits mid S1 S2. Remember, that is the minimum required 1.5 level move. That's the minimum, absolute minimum for a regular trade. And we have the close here of 31. Here at 11:22 a.m. it hits the S2. That's a 2-level move. The close $39.10. Here is the 12:30 candle that hits mid S2 S3. Close 63.22. Here's the 12:32 a.m. candle, in which it did hit a high of 76.9 on the touch of S3 before that monster bounce, but then closed at 65.95. And then here's the 1:40 p.m. candle, where it did actually touch and close through and below the S3 level, and that is $75.80. Next, we'll look at the 67.30. Alright, here's the 67.30 put. Here we see the 9:30 a.m. entry candle on the cross below, close below the bull bear KPL. $13.20 for the 67.30 put. Here is the S1 one level move scalp, 100% closeout, $17.40. Here's the 10:30 a.m. where it hits mid S1 S2 for the minimum required 1.5 level move trade for a regular trade. And as you can see, we have the $23.60. The 11:22, that's the hits S2, the 2-level ideal move, $31.78 on the close. Here's the 12:30 p.m. where it hits mid S2 S3. So that's now the 2.5 level move, close 51.50. And here was the first touch of S3 where it had the monster bounce afterwards. So did hit a high of 66.40, backed off, and on the close 49.70. Here's where it hits S3 again at 140, and not only closes on it, it closed through it and slightly below it. And you can see here 69.25. Next, we'll look at the 67.20. Here's the 67.20. Remember, this was the furthest out of the money option that we could have considered from the level that we took the trade from and the direction of the trade. Alright, so the 9:30 a.m. entry candle on the cross below, close below the BBKPL, the close $9.80. Here's the S1 scalp, 1-level move. Here is the 10:30 a.m. 1.5 level move for the minimum required move for the regular trade. Here is the S2 2-level ideal move, 23.40. Here is the 12:30 p.m. where it hits mid S2 S3 2.5 level move, $48.90. Here is the monster candle where it did hit and then back off of S3. It had the S3 touch. Hit a high of 58.58, but then backed off quite a bit to 41.93. Here's where it hits S3 again at 140, where it closed below S3. And as you can see here, the close 58. Alright, now we'll go back to the regular chart. Okay, so if you do have an interest in this indicator, as we stated in the first few seconds of the video, in that preview to the video, that if you do have an interest in purchasing this indicator, you can, in return for taking your time for watching this video today, you can send us an email at daytradinggps@gmail.com and request a discount promo code to purchase the indicator. The indicator's price will be going up next week, so this week will be the final chance to purchase it, not only at the current regular price and get the discounted promo code off of that current regular price. We will also have the promo code available next week as well. However, the base price of this indicator will be going up next week. So if you do have an interest, this would be the best week to buy it, because the base price will be going up. So your price, including the promo code, will be the lowest during this week. And what I mean by this week is through this Sunday evening. So the price will be changing next Monday morning. Okay, so like I said, you do have other videos on other topics that we described throughout this video that are in the description description below the video. If you did enjoy this video, please like the video, as it helps us with the YouTube algorithm. And if you'd like, please also subscribe to our channel if you'd like to be notified when we do come out with new videos. So thank you again for taking your time today to watch this video and learn about our indicator and our strategy, and we wish you much prosperity in all your future trading endeavors. Thank you.